Reserve Bank's third reduction in cash rates in 5 months is their attempt to increase employment and lift stubbornly low inflation. Now, the long-expected move follows clear signals from Governor Philip Lowe that the Reserve Bank was prepared to push interest rates lower to increase employment and to lift stubbornly low inflation. But what if it doesn't work? What if the desired effects to the economy don't happen and the only effect is property prices keep moving up again? To help understand what's going on, let's have a chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael. Yes, thank you for that, and welcome to you too.
Now, it seems the Reserve Bank's aware that low interest rates may backfire. In the most recent minutes, they said it was possible that low interest rates may be starting to have a negative effect on income and confidence of savers. And in their minutes, the board members said policy stimulus might be less effective than past experience suggests. They said the negative effect of low interest rates on income and confidence may make it harder for savers, and that may be a significant factor in what's going on. But they're also a bit concerned that house prices may go up. So what's going on, Andrew?
I think it's a bit of a mess, Michael, don't you? I don't think the Reserve Bank is quite clear in understanding what's going on. Could be this, could be that. This might work, this might not work. But unfortunately, we haven't got a lot left to stimulate our economy now, and what's been used so far hasn't worked. In fact, our economy seems to be going in the other direction. And of course, that conversely might be a result of cutting interest rates. So it might be interesting to the Reserve Bank to see this new paradigm emerging in terms of monetary policy, which to my mind has been apparent now for years. But it's not going to be terribly comforting for those that are looking for prosperity to re-emerge in the Australian economy, because we're a long way from that, Michael.
I know we have been speaking about this regularly in these regular weekly Property Insider chats, where you are suggesting that lowering interest rates hasn't worked overseas, so why should it work here?
Well, that's right, Michael. I mean, in some respects, we are constrained by downward movement in interest rates overseas because, of course, we need to keep our currency in reasonable balance with the rest of the world to support our export industries, which of course are a very positive part of our economy at the moment. And we really are entering an economic deep freeze to some degree. And what disturbs me most, in a sense, is that we still get the mantra of commentating regarding house price growth. That obsession got us into this situation in the first place. Moving forward, I think that really we've come to the end of the road in terms of looking for some stimulus as we've had traditionally from lower interest rates. And as you suggested, Michael, it may actually be having a negative effect on the economy in terms of sentiment. Obviously, the wealth effect from savers who are looking for bank deposits is declining. And even though we're getting some hysterical response to recent growth in house prices, which has more or less been restricted to the Melbourne and Sydney markets.
But they're out there again. They're talking about a property bubble, Andrew.
Well, it never occurred in the first place, and that's almost been accepted as truism. And now we're looking for a so-called repeat of something that never happened in the first place. What disturbs me is the language from the Reserve Bank is still talking about issues to do with house price inflation and how that would need to be addressed. And the very fact that they're talking about that again in the midst of this wasteland that's occurred, not just in our housing markets, but in our general economic performance, as I, in my opinion, believe was a direct result of taking the eye off macroeconomic ball and focusing too much on Sydney and Melbourne house prices 2 years ago, when the real issue is to try to get income growth up, inflation up, and to stop unemployment from rising, which I believe we're now going to start to see an upward trend going forward.
Well, the Reserve Bank noted in their minutes that the recent forecast that they had on unemployment and inflation for the last couple of years, in their words, is likely to be short of the bank's goals. They're admitting that it's not working. They're not going to be able to bring unemployment to the levels they're hoping for, or inflation up, or wages up. And recently, retail figures confirmed that spending intentions fell back again, adding to our economic concerns.
Well, this is all adding up, isn't it, Michael? I mean, the only consistency here is how consistently wrong the Reserve Bank's been in terms of its forecasts. The IMF has come out and they too have had to downgrade all their forecasts. Look, we've just fallen into the trap of expecting traditional macroeconomic policy to work. It hasn't worked. It hasn't worked for years. And we need to start thinking outside the square. And it's easy to say, well, we've either got monetary policy or fiscal policy, and if one fails, we move to the other. But we have a government here who's obviously going to be reluctant to move into a deficit environment, even if it means trying to stop cascading unemployment rates. And I'm not sure even if fiscal policy was reversed and we did go into some sort of a deficit environment, that we would, in the short term at least, create the jobs that we're going to need pretty soon to try to stop that unemployment rate rising towards 6%. And all this gobbledygook about quantitative easing, which I think most people who commentate have no idea what it actually means. I don't think that's going to be a solution either. It hasn't been overseas. Why should it be here? We haven't learnt the lessons from what's gone wrong overseas in their policy settings, and yet we still seem to be transfixed on following the old rules, even when they haven't worked.
As you said a moment ago, the IMF has slashed global growth in general, the outlook for global growth, and also downgraded its forecast for Australia below what the Reserve Bank's forecasts are. So they're suggesting Australia's economy is going to grow 1.7%. Now, again, we're not falling into recession, so we're not using the R word. We're not trying to scare people, but we are trying to say that there's actually little room left for mistakes from policymakers, and there is an urgent need for policymakers to cooperate. But recently, Treasurer Josh Frydenberg, he seems reluctant to put his hands in his pockets to stimulate the economy. He seems more keen to follow that political promise of, first of all, delivering a surplus, saying it's going to help the government meet the challenges in the time ahead. How about helping the economy now, Andrew?
Exactly, Michael. And it's the old tension between good politics and good economics. I'm not sure that continuing to drive towards a budget surplus, particularly when one of the old traditional arguments against deficits was the fact that you'd have to pay a higher interest rate. You know, in a global monetary system where interest rates are around zero, I'm not sure that that's going to make a big difference, particularly in an environment where our current account is looking a lot healthier than it has through our export performance. These are very vexed times for policymakers. It is difficult for them, of course, to push outside the square. But I think after years of failure in terms of predictions, in terms of policy setting outcomes, I think it's time to start being a little bit more realistic about that failure and start to look at some more worthy alternatives. The main game here is to keep people in work. We've been able to do that without incomes growth. But if we have low incomes growth and higher unemployment, that really is something to be worried about, Michael.
Well, let's put a little bit of a good spin on. While Germany, the United Kingdom, Singapore and another number of other economies experienced negative growth in the June quarter, Australia's economy still did grow faster than all the G7 nations other than the United States. And the International Monetary Fund did seem to endorse the Reserve Bank's 3 rate cuts, saying it's the job of central banks to reduce risks by easing interest rates. But they did also suggest that government's fiscal policy should play a more active role as well. Monetary policy can't be the only game in town. So maybe it is time for the government to put its hands in its pockets. What's going to happen to interest rates, Andrew?
Well, the Reserve Bank in its minutes said quite clearly nothing's worked. Lower rates may be having a negative effect. And then they've said, but we'll cut rates anyway. It's like, what? So it hasn't worked. There are risks involved with lower rates, but we're going to continue to cut rates anyway. There's growing speculation we may get another cut this year. That really puts us towards ground zero and with nothing left. And the Reserve Bank also in its minutes mentioned that there was an argument that perhaps Reserve Bank should keep some of its ammunition handy in terms of interest rate capacity in case there was an economic shock. And it answered that by saying, well, the research told it and the experience told it that it wasn't so much the cutting of rates that stimulated the economy, it was the level at where rates were. And I thought, well, we've never had rates this low before. So I'm not sure what the experience or the research counts for, let me tell you, it counts for absolutely nothing. And I think that when you mount that argument that it's about where the rates are, not the capacity to cut, when you've got a rate potentially at 0.25% or even zero, that whole argument of experience and where rates have been previously, which of course has been much, much higher, is just ludicrous. I think we need to have the capacity to cut rates in case we do get an economic shock. Global economy, as the IMF has stated, is looking a little bit ordinary at the moment. It's something we should be mindful of to keep something in reserve, particularly given that lower rates aren't working. Neither are tax cuts. And as the Reserve Bank has said, it may actually be having a negative effect on the economy.
Well, it's having a negative effect on consumer sentiment because people are getting concerned. They're stashing their cash, they're paying down their debts. And to a degree, that bit of it is good. But we do want people to spend and grease the wheels of industry and keep jobs going, keep retailing going. So some interesting times ahead. We're going to catch up once a week on Property Insiders to keep people informed on what's going on. Thank you very much for your time, Andrew.
Thank you, Michael.